I'm joined by 3 renewable energy infrastructure managers. And we're going to talk about the energy transition. Clearly, we've already heard this is clearly happening. I think Q2 of this year was a record in terms of the percentage of energy that was generated in the UK from renewables. And indeed, the Labour government has got a mission to turn Britain into a clean energy superpower and deliver zero carbon electricity by 2030. So we're going to talk about all those issues, but also the investment side of this, the opportunities for you from investing in this sector and these companies. So I'm joined by Tom Williams from Downing Renewables and Infrastructure, Purvi Sapre from SDCL, Energy Efficiency Income, and Ross Driver from Foresight Solar. And I'm going to let them introduce themselves. I'm going to ask you each just talk a little bit about your investment company, your strategy, and what you do, maybe how it's a bit different from others in the sector as well. So Tom, starting with you.
Well, first of all, thank you very much for having me on. So what do we do at Downing Renewables and Infrastructure Trust? It's commonly known as DOR. We invest in renewable energy and other infrastructure across the UK and Northern Europe. We have a portfolio strategy which is around diversification. And that is a little bit different from what others do. Why is that a little bit different? Well, I think we're a newer entrant into the market. We IPO'd in 2020. And when we IPO'd, a number of those other entities were perhaps a bit more concentrated on a single technology or a single jurisdiction. And we tried to offer a slightly differentiated strategy. Diversification we think of at a portfolio level by technology and by geography. What we're trying to do is assemble a collection of assets whose generation profiles are not correlated to one another. Renewables energy generation is seasonal, it's variable, they don't produce all the time, and actually they're reliant on different resources in order to produce. So solar, sun, wind, you get the message. So if you do that, you can ensure greater consistency of earnings and greater stability of cash flows, and therefore you increase quality of earnings and you increase, hopefully, the certainty around dividend cover into the future. At an asset or a technology level, we have a variety of specific strategies which are dependent on the nature of the assets. The largest and most successful of which is in our hydropower portfolio in Sweden, where we aggregate hydropower assets. We've got about 40 of them at the moment. We achieve efficiencies of scale from doing so, and then we modernize and digitalize those assets in order to be able to increase revenues. And that's worked very, very well for us so far.
Excellent. Thank you, Tom. Purvi.
Brilliant. My name is Purvi Sapre. I'm the Chief Investment Officer of the SDCL Group, which is the manager of SEIT, the listed fund, which is in the FTSE 250. Both SEIT and SDCL, we're focused on what we call energy efficiency. Now, and it's to address a certain sector of the energy transition. Now, what do I mean by energy efficiency? Why do we exist today? A lot of you may not appreciate, but over 60% of the energy that's generated today is lost in the system before it even gets to your kettle that you switch on. Now, where's that loss? That's in the generation, that's in transmission and distribution losses, and as you all know, as we've seen in the news, in your houses. Bad insulation, poor lighting, and it's just insane that there's that much wastage going on when there's a drive to net zero. So the way I look at it is, if any business wants to get to net zero, I love what my peers are doing, which is you need solar, you need renewables, but there's a big hole at the bottom of the bucket where you're filling up with renewables, and we need to close that bucket. To get to net zero, you need to address the wastage as well as generating clean energy, and that's why we're here today as SEIT and as SDCL. So what do our projects look like? There's 2 buckets of them. The first is what we call demand reduction. And this is reducing energy at the point of use. So what does that look like? The most obvious example is LED lighting. Now, probably all of you sitting there going, well, what's so special about that? There's still hundreds and hundreds of buildings around the world that still don't use LED lighting. Our beloved NHS is one of them as well. So the payback for that is a couple of years. in certain situations. So what does an investment from See It look like in the LED space? We will build, we will own, and we will look after those LED lights. One of our investments is Santander, where we installed over 90,000 light bulbs across their whole estate. And then what do we get back? What do we get back for that investment? Is we get fixed payments from Santander. So we get long-term visible cash flows. And the payment that Santander makes is less than the savings that they generate from lighting. So it's not rocket science. We don't take technology risk. It's very simple. But it's something that just isn't happening quick enough. People don't think of this when they think of trying to get to net zero. And then the second aspect is what we call generation, and bringing generation closer to point of use, so that where you're using the energy and where you're generating it is very close by. And a great example of this, which everyone will be familiar with, is rooftop solar. So See It, which is the investment trust, it owns one of the largest commercial and industrial solar developers in the US, which is focused solely on providing on-site solar energy. And do you know how it works? Same as LED lighting. We'll own the solar project. We'll provide energy for 20 years to a school or a hospital. And then we get fixed revenues back. We get paid for that service for over 20, 30 years. So you can see that all these projects, they're addressing the energy efficiency, the wastage use. And in return, the type of investments we get provides for long-term visible cash flows, which is why we can go to investors and say we can provide you with a progressive dividend that we have good sight of. And that's what we're trying to address. Most of our investments currently are in the US. We've got 70% exposure, and come on to that later probably as to why that's the case. But there's a huge market, and what's really exciting is that it's only just starting in certain areas. So we're very excited about the growth prospects for energy efficiency.
Excellent. Thank you, Purvi. Ross, you're from Foresight Solar, so I guess the clue is in the name as to what you do, but please tell us a bit more about the company.
Of course, yeah. So I'm Ross Driver, Managing Director at Foresight Group and the Fund Manager for Foresight Solar. Foresight Solar has been around for 11 years now. It is one of the early listed funds in the space and has been on a bit of a journey in terms of what it is we invest in and what we're doing. But the thesis of it remains the same in terms of looking to give a solid, reliable and growing yield to investors, underwritten by investment in generating assets and more latterly battery storage. So in the early years, in the sort of mid-teens, we built up one of the largest portfolios of solar projects in the UK. We have 50 assets here. They're sort of under the legacy ROC scheme. So they're about 50% of the income coming through of those are index RPI-linked subsidies backed up by the UK government, and then about half of it in the energy that we trade as well. We then moved into opening. We've run a diversified strategy in terms of different markets to access in solar. These are large-scale ground-mounted solar projects that are really sort of powering the energy transition here. We've subsequently invested and moved into Australia, where there were subsidies put out for the projects there, and more latterly into Spain, which whilst did have subsidies many years ago, is run on more of a, we run through corporate offtakes there. So we put in place long-term offtake agreements with major energy companies to buy that electricity offers to give us that certainty. And I think in a way we're all kind of in the same boat here. We're all infrastructure investors, so what we're looking to is get those long-term contracted revenues to underwrite the dividend that we're looking to pay out to investors on that. I'll just say I joined the group. I have worked with a number of people in this room over the years as well in this space and in infrastructure. It's all about those long-dated investments and long-dated returns. I think I joined Foresight Solar 3 years ago, and what is quite an interesting time in terms of this, because I think the way we're looking at things is the model is changing slightly, and especially with the disconnect that was talked about, heard Manesh earlier in terms of the valuations to share prices and things like that. I think we do think with the rates increasing, they're not going to drop down to the levels that we saw over the last decade. So what we're focusing on now is more of an income plus growth strategy and a greater focus on total shareholder returns. We're going to be driving that through development portfolios that we have. We have just under 1 gigawatt of solar and battery storage in Spain. and looking to expand our development pipeline in the UK as well. But I think some of those topics we'll probably come on to speaking about soon, so I'll leave it there at the moment.
Excellent. Well, I know already we'll probably get lots of questions from the room if the first session was anything to go by. So I have, one or two that I'd like to ask. The first one is that we've seen, if we look at the political landscape, we've seen maybe some danger of backsliding on green commitments or, perhaps slow progress on them. We saw the Labour Party downsize its plans for green energy in the run-up to the election. Other prominent politicians, naming no names, are climate change skeptics, or perhaps even some people might call them climate change deniers. I don't know. What is the risk that a public or political backlash against net zero upsets the investment case for renewable energy infrastructure? Purvi, would you like to start?
I love this question because it's why I love energy efficiency. Is that the case, and I gave some examples before, installing light bulbs, and I use that example because everyone can relate to it. You don't need government subsidies. In fact, the whole portfolio for SEIT is not reliant on government subsidies. When it comes to energy efficiency, when it comes to insulation, I think we're all aware there's been back and forth, not just with the current government, but previous ones as well. And it's helpful. It's a helpful tailwind. It brings it to prominence. It brings it as a talking point. But the case for energy efficiency, and I know that there's some bigger banks that have stolen my SDCL's phrase, which is, if it isn't commercial, it's not sustainable. The business case for, well, it's LED lighting, solar, it has to work on its own merits. And the evidence of this is the US. We've all got an opinion of where the US stands on climate change, and we might look down on them. But there's a reason, it's not by coincidence, that the majority of SEIT's investments are in the US. It's a much more mature market when it comes to energy efficiency. And why is that? Well, one of it's just an obvious answer. The US is bigger. Their definition of small is 50 megawatts, whereas that's huge in the UK. But putting that aside, it's a mature industry, energy efficiency, because it's been driven by economics. So all these steel mills, we provide waste heat recycling to steel mills. They didn't do it because they were trying to be green. That's a great side effect. They were doing it because they were trying to save money. They were trying to improve their reliability. There's storms, we're seeing what's going on in the US. There's resilience issues with the grid globally. And how do you address that? It's through on-site resilient energy. And that's not driven by regulation, that's by necessity. And so that's why we talk about, the EU has the Green Deal, there's been the Inflation Reduction Act in the US, all great, but they didn't underpin our underwriting case for all our investments. It's always been, they've worked on their own, and the regulation just helps promote the market sizing. So from our perspective, yes, I would love for energy efficiency to be more prominent and have the headlines just as a big offshore wind farm does. And as I mentioned before, there's certain areas, particularly public sector, where there's been issues around taking private money to help implement things, and I mentioned NHS before. That's where it'll be helpful. But when you come to the big, heavy energy users, which is in the private sector, commercial, industrial, they're going to do this anyway, regardless of where government regulation is, because they need to save money. And sustainability is high up, but you get the two together and you get a great business case.
Excellent. So it sounds like you've got a very solid appeal to people's bottom line there. Ross, would you like to?
Sure. In terms of, I think government policy in the UK has been helpful with the change of government and the direction of travel that's been set. And I think for the solar, if I talk about the solar industry specifically, I think it's been helpful after several years. I agree with Purvi's point that these projects shouldn't need to rely on government support to prop it up. But I think actually the direction of travel and the government announcements are expanding the pots for CFDs, which is more of a balancing mechanism for these projects, has just given good direction after several years of policy sort of bouncing to and fro over the last few years. You've got the Energy Secretary signing off some of the biggest projects that are coming into the UK as well. So it just shows support for solar as a resource in the country. I think we look at it in terms of actually having a balanced grid, so having wind, solar, and then storage to balance that is one of the best ways forward. I think we do have a leading the leading offshore wind market in the world that's been supported by strategies such as the CFD, but having solar as I think can be a more reliable technology in some ways, because at least the sun does come up most days. Wind has volatility as well, but solar can deliver a solid baseline there, I'd say. So I think the way that we're looking at it, direction of travel is good. I do agree with the point that these projects should also be able to stand on their own 2 feet. But I think promoting that level of investment into the country is great, because we're starting to see contractors, we're starting to see people ramping back up to build out the energy transition that we'll need. And that also facilitates actually corporates coming in to buy our energy offers under PPAs. So therefore, you're not reliant on on government and support. I think going back to the question around whether there is risk of a potential backlash from the public, I think we've been through those years of incredibly high energy bills, and we're still waiting to see those come down. The best way to get energy bills coming out is to build out greater renewables that have zero net marginal cost for delivering. And until we sort of see that start to displace gas in the future, we need the benefit to be coming down to the consumers to seeing it in their bills, really.
Right. Tom, would you agree with all that?
Yeah, no, I really do, actually. So yeah. I think in all of our target markets, policy is only going in one direction. Mm-hmm. There are undoubtedly going to be ups and downs. I think explaining to people that you are going to save an awful lot of money in the future by investing today is a difficult message when people are in the middle of a cost of living crisis. So, that is something that everybody has to tackle. But there is no doubt that this is all here to stay. Renewable installations globally are increasing at an exponential rate. And so the opportunity set for all of us is growing in a similar manner. And I think that's the most important thing for the room to understand, that this is not a contracting sector. This is not a stable sector. This is a sector that is growing at an unbelievable rate. And frankly, the money that we need to invest in it is not keeping up with the ambition globally.
Okay, thank you for your answers to that. I'd like to turn to the room now. Do we have any questions from the room? We've got a few. Wow. Okay, we have this gentleman here on the front row. Could you please wait till you get the mic before you start asking the question? Thank you.
Thank you. The name's White. One hears that most of the wind farms in and around the UK are owned by non-UK investors, which worries me. Can you say anything about this? That's one question. And for someone who is interested in long-term investing in wind farms, what are the routes to do this that involve the minimum amount of intermediation? How directly can one own them? And how can one avoid lots of people taking percentages on the way?
So a question on wind, I suppose, is most relevant to
well, sort of, we have investments in wind, actually. Downing, more broadly, we don't just manage the listed investment trust. Actually, that's a smaller part of our business. We have investments in wind in the UK and in the Nordics. I actually think the investment trust sector offers you a pretty direct and low-cost route, actually. You are investing in a vehicle which directly owns those assets. So that's about as little intermediation as you can get, actually. It's not that we are investing in other funds that then themselves invest in something else, which invests in something else, which eventually there's an asset at the bottom of it, right? So, I think in terms of foreign capital owning infrastructure assets anywhere in the world, I'm not sure I'm particularly fussed about that, to be honest. I'm more focused on the fact about what this is delivering to the country. Right? So what is that capital bringing in? It is bringing jobs. It is bringing opportunities. It is bringing energy security. And it is securing our long-term future. And I think those are things that you want. And if capital from other parts of the world wants to come in and fund that, I think that's amazing. And I think we should have a lot more of it.
Any more comments on foreign investors in UK renewables?
I agree with Tom today. So there, I think we're going to need international capital from everyone. I think if the gentleman's question is which countries in specifically, or concerns about other sort of less friendly regimes. I think there are checks that have to go through in terms of the investors that can invest in these assets. But I think what you're seeing is big global investors putting money into things such as offshore wind, because they're huge projects that need a lot of capital to fulfill them. And I think we need that inflow into the UK.
Excellent. An excellent point, Tom, of course, about the investment trust structure and how that is obviously a marvellous way to get exposure to these assets. So thank you for making that for me. We've got a question at the back there, please.
Oh, Mr. Chairman, ladies and gentlemen, members of the panel. You know, I had to get up rather early this morning, so I'm not quite sure whether my wires are all connected together yet. But I'd like to ask the panel about the disconnect which I see between the industry, politics, the public, and the environmental movement. And the need to join those groups together in order that we can go to war against climate change. As a member of Greenpeace and Friends of the Earth, I canvassed before the election to get members of the public to vote for the climate. I've been a real pain at Conservative Party meetings when I stick my hand up repeatedly about climate change. So how can industry push forward this connection agenda?
Would you like to take that, Purvi?
I'll say, well, I'll start, but I'm sure other people will finish. I think the panel has talked about, and I have certainly, around so the benefits of whether it's renewables, whether it's energy efficiency, which is, it has to be sustainable. There must be more to a solar project or to an energy efficiency project than just getting to net zero. When I say just, I'm using that word purposely. That is a key part, but people need to see how it benefits them. So whether it's reducing your energy bills, whether it's improving reliability to reduce blackouts, and like I said, this applies globally, not just in the UK. It's the whole transition to net zero needs to be just. It needs to be fair, and you need to explain the benefits to everyone, not just one group of people. And maybe there's a lot more that can be done on that. You know, it's quite easy to just say, oh, well, we're going to get net zero and that's it. And it doesn't matter what, but we're all getting hit by high energy bills. We all want to see those reduce. So understanding that and the communication is going to be critical. And it's not, I think everyone has everyone, whether it's private investors, politicians, has an obligation to explain the whole story and how that journey is going to work.
Did either of you have any quick comments on that one? Or...
I just think that everybody here on the panel has a part to play in that, right? We are part of the solution, right? We're trying to offer people a way of investing in this sector to get good returns and make a difference. And the critical thing is the good returns bit. You know, the making a difference comes with it, right? And it used to be, when I started off looking at renewables, you know, 15, almost 20 years ago, that you had to pay a price in order to make a difference. You had to accept a lower return or greater risk. Now, I think what you're hearing here is 3 very good strategies that can deliver you very good returns and make a difference.
Excellent. Thank you for your question. I know we've got lots more questions in the room. We do have people online as well. I've got 2 here I'm going to join together, which are quite specific. One of them is, do DOR and FSFI consider themselves too highly geared? I'm guessing the answer is no, but the other one is, are boards and investment managers doing enough to manage debt and make prudent capital allocation decisions across all renewable infrastructure trusts to tackle persistent discounts to NAV and restore investor confidence? So 2 connected questions there, I think.
Happy to
Ross,
kick
would
off
you
with
like to
that one
start?
because
Yeah.
we hear it all the time from our investors at the moment.
Yeah.
So I think, well, I can only speak to ourselves at the moment. I think our total gearing is about 38.5% at the moment in terms of that. And all our debt was actually raised, the majority of it, about 8 years ago, locked in at an average price of about 3.5%. All in and totally hedged out. So I think we constantly look at our capital structure to see if we can beat it, and I just don't think we can in this market at the moment. We'll look at re-gearing that in the future. I think the one key element, and it's similar to most of the trusts, the way that we're set up, is that they would have these revolving credit facilities that in I'd say usual markets, you'd buy assets with them, you'd use those, and then you'd go out to raise equity to pay them off. That's the only variable rate debt that we've got in our portfolio. We've already paid off about 45 million of it at the moment. We've switched some of it with a multi-currency facility into euros to benefit from cheaper Euribor there, and we're continuing to pay that down. I think we know that it won't get to the low levels that we've seen in the last decade, like we said before, but there will become that balancing point at which it makes sense to go and start reinvesting in assets again, as we've seen those returns nudge up slightly as well.
Thank you. Tom?
I think our answer on gearing is very similar to Ross's, actually. We are at roughly similar levels of gearing. We don't have any interest rate exposure till 2033, I think, at the earliest. And we've got some small level of borrowing at the RCF facility, which we're planning on paying down with the proceeds of a sale of one of our assets. Very, very similar. I think on the broader question of the phrase "restoring investor confidence," I think is an interesting one. I think that what we see, and I think probably my colleagues share, is that we can't buy the assets in the market for the prices that is implied by the current discounts in the trusts, right? And believe me, we've tried, right? And we're really happy if we could, but you can't. Okay, so there is just a fundamental disconnect at the moment between the public markets and the private markets, and again, we heard that in earlier on as well. And people are evidencing that in a whole variety of different ways, not least of all, selling assets from the portfolio at premiums to NAV or at NAV. So I just don't think there is a problem across the sector with valuations. I think the assets broadly are where they should be. So this is, it's our job to try and persuade everybody out here that these represent good value, because the private markets think they do, because they're buying these assets from us at NAV. The problem is that the public markets don't quite see that, and then you can go into a whole question about, why is that, and what are the pressures? Are they specific issues facing the listed market that perhaps private investors don't have? Maybe, but I don't think there's a fundamental problem with the value of the assets in any of our or our peers' portfolios.
It does seem to add up to an extraordinary opportunity, and it's probably worth saying that analysts who are looking at the market agree. And analysts looking at the market in different ways, different valuation metrics. I agree with what you've just said.
Yeah, I mean, the sector's sitting on an average double, I think most people are a double-digit discount. We're a 27% discount. It's an extraordinary opportunity to come into the sector right now.
I would totally agree with this. We didn't get I wasn't included in the question because we're actually even lower geared, and we have been for a while. But that doesn't mean we haven't suffered the same. We're at a double-digit discount as well. I would say, and I'd echo what Tom was saying, which is about communication to everyone about what we're doing. If anyone has time or inclination, I would ask them to go to our annual report, where we've got a 6-point plan to address the discount, and it's something that we are spending majority of our time for existing investors and you to address that. Some of that involves bringing in new investors. We've got a substantial new US investor who has come in to see it, who's also recognized this dislocation between share price and NAV. Actually, a third of our portfolio is actually externally verified as well. So whilst we conduct very intensive valuation processes, we're getting third parties now to do more and more to give that extra support so that you can take confidence in the NAV. Other things we're doing is improving disclosures, because we all know listed funds, there's only so much you can read and try and interpret what's going on in the portfolio. So spending more time with that. And
I'm really sorry to cut in there, and I'm going to apologise to everyone. We haven't got any more time for questions. I don't know if you're going to be around for a bit afterwards to chat to people. There's obviously a lot of interest in this issue. I'm actually quite excited, both by the investment opportunity and what you're contributing to the transition. So thank you very much for joining us today.
Thank you.
Thank you.